Welcome to the conference on the FX Global Code. This conference will be recorded. May I now hand you over to the moderator, David Clark.
Thank you, and good morning, everybody. I'm a member of the Global Foreign Exchange Committee's buy-side outreach group, and I'm very pleased to be able to welcome 4 members from this group today, 4 market participants who come from different parts of the world, from Australia, here in Europe, and the United States. We have on the panel Klaus Kohl, who's the head of Treasury and Reporting and Middle Office at Airbus, Robbie Bukufane, Portfolio Manager at Schroders, Stuart Simmons, Senior Portfolio Manager at the Queensland Investment Corporation, and Michael O'Brien, Director of Global Trading at Eaton Vance. And all of these panelists have been involved in the formation and the work that has been done to produce the Global Code of Conduct and the work that is in progress since then, particularly in respect of the buy-side firms who are increasingly signing up to the Code of Conduct. What makes the foreign exchange market so special? It is a complex and very diverse market, and it needs, therefore, a set of guidelines for fair, effective, and robust trading. The nature of the market is inherently complex. Activity takes place across multiple venues. There is no single trading venue and no single price. Trading happens 24 hours a day, spanning multiple centers. Participation is diverse, with banks, asset managers, corporates, central banks, each transaction foreign exchange to meet their own different objectives. Participants act in different capacities, as principals, as agents, as liquidity consumers, and as liquidity providers. A common set of guidelines is therefore essential for promoting integrity and restoring confidence in the foreign exchange market. Why was the code developed? The Bank of International Settlements governors commissioned its market committee to develop a common set of guidance to the FX market after the difficulties that we experienced a few years ago. The objective was to help restore trust and promote the effective functioning of the foreign exchange market. This was done through private public sector partnerships and collaboration on a global basis, who all participated in promoting and incentivizing adherence to the Code of Conduct. Part of that process required a review of existing codes of conduct, and then through the Global Foreign Exchange Committees, work that was done to bring together those participants on a worldwide basis. All agreed that a common set of guidelines allows participants to have much greater confidence in the market and that it functions appropriately. To use the words of Guy Debelle, the Deputy Governor of the Reserve Bank of Australia, in his opening remarks for the launch of the code in May 2017, in a globalized world, he said, the foreign exchange market is one of the most vital parts of financial plumbing. The contribution to the code's development came from the official sector, from the buy side, the sell side, infrastructure providers, platforms, and trade associations. There were 16 central banks involved. There were over 15 major asset management firms and corporates, around about 30 domestic and international banks, and over 20 trade associations and infrastructure providers. During this process, over 10,000 comments on the drafting of the code were received by the committees around the world. And the result is a code of conduct which is by the industry and for the industry. Let me turn to the panelists now. Stuart, if I may start with you, QIC is an Australian asset manager. You've always been a strong advocate for the FX Global Code, alongside other areas of responsible investing. Now, you suggest that the code goes beyond conduct to represent a framework for best practice. Can you elaborate a little on this?
Thanks, David. There is a perception that the code is simply a code of conduct, and this is generated indifference across some buy-side participants who view it as a code for others, the bad apples in the market, not for them. As you've mentioned, going back to the beginning, the motivation for development of the code was primarily to restore trust and integrity into the wholesale FX market, but it actually goes well beyond that, representing best practice for the institutional FX industry across governance, execution, risk management, and settlements. Paraphrasing Chris Kemp from the RBA, it's essentially going to get increasingly challenging to explain to your investors and stakeholders why you've not adopted a set of practices that represent industry best practice.
Yeah, Stuart, what is in the code for the non-banks? You've signed up for the code, and many others have, but what is the principal motivation that you have seen that you would advise to others for signing up to the Code of Conduct?
Sure. Well, not only does the code help market participants establish best practice, but importantly, it also informs on what the buy side should expect of their counterparties. Now, this is a departure from an era where parameters around counterparty relationships were weak and expectations largely undefined in many areas. With many banking signatories to the Global Code already, the buy side now has a framework of what conduct to expect from their counterparties and are well armed to ask the right questions and, importantly, seek recourse if necessary.
Yeah, Robbie, at Schroders, you were among the first asset managers to adopt the FX Global Code. Could you explain your motivation for this and some of the benefits of adopting the code from an asset management perspective?
Sure, David, thank you. Well, look, firstly, I would say that rebuilding trust within the marketplace and indeed rebuilding the public's trust for not just the foreign exchange market, but financial markets should be a motivation for all market participants to sign up to the code. If I take a look at our motivation at Schroders, and I can break this down into four main areas. So firstly, putting the interest of our clients first. You know, we have a strong belief that all asset managers have a duty to act with integrity within the marketplace. I mean, the code wasn't created just to clean up the banks or the sell-side counterparties. This is for all market participants globally. So acting with integrity is a core value for Schroders across the business. So we view signing up to the code as a way of demonstrating to our clients, other market participants, and indeed the public, that we are committed to acting with integrity and strongly believe in good market practice with ethical and professional conduct. So basically, you know, we essentially want our clients to know that when we act as agent on their behalf, we approach order handling in a professional manner. Secondly, and the second section, robust governance framework. So again, improving outcomes for our clients is an ongoing goal. It's something we are continuously looking to do. And in order to achieve this, ensuring there is a robust governance process is an essential part of achieving this goal. So we felt that adopting the code can help asset managers build, assist, and in our case, help to strengthen the governance process with the ultimate aim of improving client outcomes. Thirdly, I would point to the transparency element of the code. The code promotes a robust, fair, liquid, and transparent marketplace, and this is consistent with how we run our FX activities globally. Educating traders and having a better understanding for how orders are being handled can influence decisions on the most appropriate way to execute orders. And finally, in response to this question, David, I would say that being part of how the code evolves is also a huge motivation for Schroders. You know, the asset management community manages trillions of assets. I think the last time I looked, the 500 biggest managers manage approximately $90 trillion in AUM. So the money across the asset management industry, for me, has become the most significant client segment. So the asset management industry need a voice, and they need to be involved in how market structure evolves going forward. Now, this has started to happen in certain forums and committees, but in my opinion, more participation is needed globally. And as electronic trading evolves, my view is that it is imperative that collectively we play an active role in how the code evolves to ensure transparency and good market practice remains a top priority for the FX market.
Thank you, Robbie. Now let's move to the manufacturing sector here. Klaas, you represent a huge international manufacturing corporation in Airbus, where your core business is not necessarily linked to the foreign exchange market. Why is it important for you and other non-financial corporations to adopt the global code? And how did you think about this at Airbus?
Yeah, thank you very much, David. At Airbus, we are, like many other corporates, not linked to the FX market as core business of the company, but nevertheless, we have, of course, quite an indirect impact of foreign exchange markets. If you imagine that aircraft are typically paid in US dollar, and as a mainly European manufacturer, we have a significant euro cost, you can imagine that the impact of the FX market is important to a company like Airbus, and therefore we have an interest due to our own positioning in the market that we can execute the foreign exchange hedging attached to it in a fair, liquid, transparent, and robust market in order to secure the operational business that we are running. And this is true to a different degree to many other corporates as well across different industries. And I think as buy-side participants, we have still to lead by example. We have a collective responsibilities towards conduct in the market, and there are some principles that are, of course, applicable to all market participants in the same way when you think about ethics, information sharing. There are other principles where proportionality applies, but nevertheless, we are, as Airbus, committed to continue to act according to the principles of the code. We have been actively working in drafting the code, and we expect from our counterparties to live the code as well. And we can only expect that from our counterparties if we are committed ourselves. Of course, we saw that as an opportunity to adapt our own practices, our own processes to best practices. So, of course, the adherence process triggered a few questions on our internal processes, and we adapted some of them in order to let's say, benefit from what the code also describes as a best practice. And we see it finally as a puzzle piece, as a cornerstone of a global ethics and compliance framework within the company.
I appreciate very much those comments, Klaas, and mentioning leading by example is something that I think we have all managed to identify as being a key strength of bringing market participants together with the authorities and the buy side and the sell side. Michael, Eaton Vance was part of the Market Participants Group, which is a subgroup of the BIS-FX working group, and which was responsible for drafting the code. Let me ask you if good governance is becoming a bigger consideration for asset owners before they hand the asset owners the assets and the mandates over. The question partly is the client's client here. How important has the code and the governance aspects of the code been to you, and how do you see that for the future?
Sure, thank you. Eaton Vance did join the Market Participants Group along with other FX professionals to contribute feedback to the code. So the code would reflect the best ideas of those who are actually interacting in the foreign exchange markets on a daily basis. I think that's an important point of emphasis because the code was created with the guidance of our peers in the market rather than outsiders. I think this feedback was critical to establishing a credible document both to those looking to meet global best practices standards like asset managers, as well as asset owners who are looking to see in industry benchmark and best practices that they can measure asset managers against. So to answer your question, yes, good governance is becoming a much bigger issue to asset owners looking to allocate to managers. The asset owners want to know that their managers are using and up to the highest standards. As a result, I believe that adherence to the code will initially be a competitive advantage because those who adhere will be able to demonstrate a commitment to best practices to those asset owners. Eventually, however, I think that the code and what it represents in best practices will be a requirement placed on asset managers by asset owners. Those who have not adhered could be left out in the cold when it comes to winning mandates from asset owners. The market pressure from the asset owners, which I think will eventually evolve, is not the only reason asset managers should be interested in the code. Asset managers are also looking for that benchmark on best practices to ensure that their businesses are keeping up with industry developments and the evolution of the industry. And adherence to the code provides a tool for managers not only to demonstrate that they're up to these standards externally to asset owners, but also internally within their companies and responsible parties that they are adhering to those standards.
Good, thanks. Well, on that note, let me come back to you, Robbie. As a buy-side participant, were you concerned about the quality of the service you received from your sell-side counterparties, the costs or the integrity? And do you think a broad-based sign-up to the code will improve the quality of execution and pricing that you and other buy-side participants receive?
Thanks, David. Look, we didn't have any issues with individual sell-side counterparties, but obviously we had concerns about the integrity of the marketplace. I mean, when a number of sell-side counterparties get fined by regulators, it's natural to get concerned about integrity. I mean, even with a robust internal governance process, it would have been really hard to detect all bad behaviour and quantify the influence this was having on costs. So for us, I think fear of the unknown played a part here. In terms of improving the quality of execution, I mean, you obviously don't improve the quality of execution simply by signing the statement of commitment. However, in our opinion, being part of the code provides asset managers with a platform that can lead to improvements in the quality of execution and improve client outcomes. So, it improves transparency, enables asset managers to have a more robust understanding of how their orders are being handled, and provides the ability to challenge sell-side counterparties with regard to execution across all their workflows.
I think this has been a very helpful discussion around the benefits and motivation for signing up to the code. Let us move on now to implementation. Assuming the buy-side firms share the views that we've heard about the benefits of signing up, then comes the question of how do you go about it? What do you have to do? Klaas, I'd like to ask you to start with this, please. What happened at Airbus? How did you bring this to the attention of your management? Because obviously you were committed to it, you'd worked on it. What processes took place internally at Airbus which led to the signing of the Code of Commitment?
Yeah, we started classically with a gap analysis. We were mapping our internal processes against the principles of the code. That provided a much better understanding of also what happens in the market if you execute a trade. We identified, as I mentioned already earlier, a few points where we could improve our internal processes that were mostly around a few questions on settlement and a few questions on business continuity. Nothing dramatic, but clearly ideas of how we can improve our internal processes. In a second step, we reached out to the top management. Globally, the FX business is assigned to the integrated treasury team. There's some oversight by the foreign exchange committee where all hedging decisions of the group are taken, and this committee is chaired by the CFO, so it had this kind of attention already from the beginning. And then formally, we went for a signature by the group treasurer, who was involved through diverse committees already at the very beginning of the journey to write the global code, and who asked his team, including me, to work actively at the MPG at the time. Then we were cascading, finally, the commitment to the affected staff. So we made everyone who's dealing with foreign exchange transactions in Airbus of the code, of its principles, provided our mapping of our internal processes and our thinking on how the different principles are applicable to Airbus. And then the effective staff was also signing an internal statement of commitment. And as a final step, we are providing online training for employees to, let's say, refresh and revalidate their knowledge about the FX Global Code at any point in time.
Yeah, that's a very helpful roadmap, Klaus, that you've given us there. Stuart, could you add maybe a little to that by talking about the element of proportionality? In other words, the impact of the size and complexity of the firm's foreign exchange activities and engagement, and the impact of that on trying to adopt the 55 principles in the code.
Sure. Well, proportionality is a critical element within the code to ensure that its appeal is broad-based across different sectors and across the institutional FX market. The steps to adopt the code are necessarily proportionate to the size and complexity of its activities and the nature of engagement with the FX market. That's essentially the formal definition. But in simple terms, this means that the procedures for a smaller asset manager or corporate do not need to be aligned to that of a large bank. The roadmap to adherence can follow a similar path, but the complexity will differ across different market participants. So it's highly likely that a number of the principles within the code do not apply to them, and that's certainly the case with QIC and others. And some other principles within the code will only apply to a limited extent. It's basically up to the judgment of the market participant themselves how their practices will align with the code, and that's the proportionality.
Good. Robbie, in your experience, what were the key challenges and concerns in implementing the global code from a practical perspective, particularly in respect of getting senior management buy-in?
Thanks, David. Look, I think this boils down to time and resource. You know, every senior manager will want to know the cost of how much time and investment we need to implement adherence in this case. Now, if you think at the time, we had other market-wide regulatory commitments, and also Schroders had internal infrastructure commitments. So as I said, the senior management buy-in or persuasion was not to do with the code itself. It was to do with the time and resource needed. And I can elaborate on that a touch. I mean, if you look at the overview of the main principles, it demonstrates that the code covers the full life cycle of the foreign exchange transactions. Now, when you put that into context with Schroder being a diversified asset manager, which incorporates a treasury arm, a wealth management arm, and an asset management arm, we're onshore in many countries around the globe, and that incorporates a range of different compliance, legal, and investment teams. You could see that collaboration is hugely important. So, as I said, time and resource were the main aspects and challenges in terms of getting this over the line. But the fact that we were one of the first asset managers to sign the code demonstrates how important we viewed it. I mean, another consideration for us was that given the statement of commitment is a public statement, we needed to ensure we were 100% happy and comfortable with adherence. Now, our opinion is that the principles are generally recognised as good practice, and as regulatory bodies such as the FCA have stated, the Global Code does not impose legal or regulatory obligations. And what it does do, it essentially allows the industry to police itself in support and as a supplement to local regulations. So, after consideration, that was no problem whatsoever. And then lastly, I think just on the attestation and how we continue to demonstrate adherence going forward, this is something that we've created an internal sign-off process for, as well as sort of trader education. So, we will continuously review our adherence and sort of monitor that internally through the governance framework.
Michael, you've been very involved in the way that this has been working out in North America. Would you have any advice to those listening and watching the webinar who may be unsure how to sign up to the code and may have doubts about the value of the code? Can you explain in that sense why also this code will be different?
Sure. I think the value in the code and why it will be different is largely in how it was created. As I mentioned earlier, this code is different and unique because it was written, or at least the feedback was given by market participants for market participants. It's a robust document, having been through many versions before the final version was released. The process of writing the code and providing the feedback involved bringing together subject matter experts in each topic that was addressed. It wasn't one group representing firms working on every topic, but specific subject matter experts getting to share their feedback in each area of the code. Hundreds, if not thousands, of hours were spent on developing this code. And additionally, it was a geographically diverse group of market participants on the market participants group. So it doesn't just represent the best practices of one financial center, but it's truly a global code. And as a global code, it applies to all FX market participants rather than just one region, and harmonizes best practices globally instead of regionally. I think it's also important to note that the code is intended to evolve with FX markets. It's not intended to be a static document, but a living document that will change as FX markets change. So I think the real value to buy-side participants in adhering to the code is to join this global ecosystem and have their best practices evolve in real time with the rest of the market rather than separate and dark from everybody else.
Okay, well, let me ask the last question, if I may, to Stuart. We started with you. And Stuart, perhaps you consider how the buy side feel about signing the code. And do they feel as if the market is treating them more as equal players vis-a-vis the banking counterparties that they have? And do you think that buy-side firms see their position in the market strengthening as a result of adopting the Code of Conduct?
Thanks, David. The code is often seen as a way of levelling the playing field, enabling the buy side to operate more effectively alongside banks in a market that is both fairer and more transparent. And without question, buy-side firms, both individually and collectively, have a stronger position in the market, but it does hinge on broad-based adoption of the code, without which it probably won't prosper. The benefits are clear. However, only a fraction of the market participants who have signed the code are from the buy side, and only a fraction of the buy side have adopted the code. So increasing awareness of the code helps, but we really need adoption from all types of market participants to guarantee the future integrity of the market.
Well, let me draw this to a conclusion. We've discussed the benefits of the Global Code of Conduct and also the steps towards adhering to the code. Anybody listening can find more information on the code or reference material if they wish for it from the Global Foreign Exchange Committee webpage. We also encourage all of our audience to reach out to their bank contacts, local associations, and regional foreign exchange committees in case they have any questions. And we invite all of you to contact us here at the ECB and on the subcommittee if you have any further discussion points you want to raise or questions that you may have. We hope that this webinar has brought to your attention the importance that all market participants are attaching to making the foreign exchange market a venue of integrity, shared values, and efficiency. As the largest financial market in the world by traded volume, it plays a crucial role in global trade and services. and it deserves nothing but the best in terms of conduct and behavior from those in each part of this market. We appreciate your attention today and are ready and willing to hear and understand your support, comments, and concerns about joining so many other market participants in working to improve the foreign exchange market. Thank you all for your attention and participation,